Let's talk inflation, shall we, while we are talking about yields. And let's bring in Torsten Slok of Apollo Global Management. He's the chief economist there, friend of the program. Torsten, it's great to see you. This inflation debate has been raging, of course, with an eye on the Fed and whether they're going to be behind the ball when it comes to inflation. You're watching inflation too, and how perhaps we could see the transition of transitory inflation to more sustained inflation. First of all, why don't you walk us through how that could potentially happen?
Yeah, this is very important and a very important debate, Julie. If you think about what the Fed is saying, they are saying we will see a temporary boost to inflation and then it will come down. But if we look at what's going on with commodity prices, with energy prices, with lumber prices, that is definitely only going one way, and that's up, because the economy is reopening. You have had very strong manufacturing, and that all argues for a continued upward lift in commodity prices. And that does not feel like that's only temporary. It does feel like if the economy does continue to open, we will continue to see commodity prices go up. The other anecdote that is very pronounced and becoming more intense at the moment is that there are a significant number of stories about companies that simply cannot find the right workers for the job openings that they have. We saw in the jobs data here earlier this week that we have seen a significant increase in the number of job openings. So these anecdotes also suggest that there are increases in wages and in the labor market, and mismatches, if you will, in the labor market that potentially also point to higher wages. And if you combine these two things of commodity prices going up and wage costs also beginning to move up, just as an anecdote, as you saw on the last Friday, wages in leisure and hospitality is now year over year at 5%. It jumped quite significantly in March. You should not expect to see higher wages in leisure and hospitality because there's so many people that are still unemployed in leisure and hospitality. So combining these things, Julie, to your question, I would say that there is significant upward pressure on input costs for companies. And this raises the question, what does that mean? Does that mean that margins will be under pressure, which is a likely scenario? Does it also mean that companies will begin to raise prices of output things that they're selling, meaning consumer prices? And all that does begin to open up issues for markets about, well, if margins are under pressure because input prices and input costs are going up, and if at the same time there's a risk that higher inflation might be coming in consumer prices, then that does begin to ask questions about whether investors should not begin to pay attention to inflation, not only in consumer prices, but also in input prices.
And there we saw the opening bell on this Wednesday morning there. Torsten, let's talk a little bit about the Fed's reaction function and how it might fit into that inflationary environment. Because if we go back in time 3 years, inflation was running, 2.1%, 2.2% maybe. And the Fed went and raised rates 4 times in 2018. Now, we can argue about whether they were pushing back against that specific inflation. They were continuing their cycle. But Jay Powell, essentially, as far as I can see, wants investors to forget that period in Fed history and say, we are now completely different. But the way I hear you talking, the risks are too great for investors to truly take Powell at his word there. They must consider the possibility that he does indeed react similarly to the way the Fed reacted just a few years ago.
Yeah, I think the tension in the market is that the Fed might be saying, oh, we just don't want to look at this boost in inflation. Let's just ignore that. But if you are a company and you are facing higher commodity prices, higher energy prices, if you're a company and you suddenly have to pay workers more, you can't just take the luxury of saying, oh, I'm just going to ignore those higher costs. You need to make a decision. What do you want to do with the higher input costs that you have? So the tension is in some sense that the Fed is saying, oh, just ignore that. Whereas if you are a company that's planning over the next several quarters, you need to think about, do I just want to ignore that increase in input prices, or do I actually need to take that into account? And that is the challenge here for markets, that if it does, as Julie said, they may see this transition from temporary lift in inflation to become more permanent, then the risk, of course, will be that this will not just be a temporary boost. And as Larry Summers and Olivier Blanchard have been saying, that this might be not just, as Blanchard was saying recently, this is not just overheating, this is like starting a fire. Then the risk is that we might have this transition away from temporary boost to inflation to a more permanent inflation problem. And then you will, to your point, Myles, have that the Fed will then come around and say, okay, then we do need to recognize that inflation numbers are higher on a more persistent basis.
Torsten, Jamie Dimon out this morning in his annual letter noting equity valuations are, quote, quite high, but they could be justified because of the economy likely booming in the months and years ahead post-pandemic. Two questions. One, do you see the economy booming this year? And then two, do valuations where they are right now, do they currently reflect that boom?
And that's fair, Brian, totally to say that the valuations are high. But what's also fair to say is absolutely that if the economy is reopening, you should expect the E in the PE ratio to go up. In other earnings should be improving if you get into a situation where you have more service sector jobs, more service sector parts of the economy coming back. The horse race in this situation is that, yes, we are reopening the economy, and therefore you should expect to see earnings go up purely as a result of that. But at the same time, if the costs of producing things, if the cost of being a corporate also go up because commodity prices are going up and wage costs go up, then it becomes a matter of what goes up the most. Is it the increase in, if you will, top line growth because of the economy reopening that goes up the most? Or will you see an even bigger increase in input costs of production? And that's where investors, in particular in credit and in equities, will need to be more careful. And in my view, there is a significant risk of turbulence ahead as a result of this uncertainty about input costs going up and what that will mean for markets and ultimately for earnings. Because if earnings begin to see some downward pressure on margins as a result of high input costs, which is not just temporary, this is what you should expect to see for the next many quarters as the economy reopens, then I do think that equities and also credit, it does look relatively rich at this point. In other words, relatively expensive compared to the underlying risk that inflation, not only on output prices, meaning consumer prices, but also on input prices and input cost, is now moving upwards.
So let's come back then to the level of inflation and how it pertains to the economy and earnings. What's the magic number, Torsten, where it really, the tipping point where it becomes problematic? Because the Fed wants inflation, right? That's part of this equation. It wants inflation as a reflection of a strengthening economy. Where is that tipping point from where it's a reflection of that strength to it's a dampener of growth because inflation is too hot? What do you think that number is?
I would say that the magic number is 2.2, because the Fed used to say, as Myles just pointed out, the Fed used to say that we just want inflation to be 2. Now they're saying we want inflation to be 2 over some period of time, which is suddenly opening up the possibility that we can overshoot 2 for a while. And to your very good question, what does that then mean? There's a lot of different interpretations of what the Fed is actually saying and trying to tell us in the market at the moment. But my interpretation would be that if we are above 2.2 on core PCE, which is the Fed's preferred measure of inflation, then we will, for a, say, 6 months period, see inflation that is above that level. We will begin to see rates investors say, well, wait a minute, if you're going to allow inflation to be above this magic number of 2.2, or at least substantially above 2, I need to be compensated as a fixed income investor, not only in treasuries, but also in credit, for the risk that inflation could also be 2.5 or maybe even 3. Because remember that inflation that goes up above 2.2 or to 2.5 or 3, that would be an erosion of my portfolio if I'm a bond investor. And that could, of course, also ultimately become a risk for equities. So it really is a very, very careful game that the Fed is playing here, where they're saying we want inflation to be a little bit above 2 for an extended period, but we just don't want to exactly specify what that means. And therefore, the market will have themselves to begin to second guess when this will become a worry. And as a bond investor, if there's something you don't like, it is certainly inflation eroding the value of your returns. So from that perspective, your question about at what level should you begin to worry becomes very important, because all these things will ultimately mean something for what will the level of 10-year rates be. If there is another inflation uncertainty premium that needs to be priced in, that will ultimately mean that we will begin to see long-term interest rates move further up.
Yes, and we'll begin that talk again about the market forcing the Fed's hand potentially. Torsten, always great to chat with you. Torsten Slok, Apollo Global Management Chief Economist. Thanks for your time.